So our first class, and just my goal tonight, probably most of my classes, I go the full 75 minutes. The first class for my 9 o'clock class tends to be where I let you out early because it's so late. In this class, I don't have trouble getting behind on this class like I do in some of the others. So we might get into the economic, I'll at least show you in the notes. But so again, I'm Ron Sweet, been at UTSA for 20 something years. The very first class I taught at USA was the life insurance finance class, because they had these 2 insurance classes and they didn't have anyone to teach it. And so I did that many years ago. I only had 5 students in that first class. And then they added the P&C and the risk. So, you know, they're trying to beef up the insurance side. You can usually find me in the FSC Monday through Thursday in the afternoons, except for when I have class. And once we get back on campus, February 7th. Those are my official office hours, but you're free to call me or email me anytime, set up other times. So essentially, anytime I'm not in class, you're free to call me. As I tell all my students, I'm on a bike every morning for 3 to 4 hours. So you can always call me then. It's really easy for me to talk while I'm on a bike. So if you have questions, they can be questions about the class. They can be career questions. I'm not an actuary, but I've spent enough time with actuaries. I can certainly talk about that. So I know we've got some actuarial majors in here. Not only that, I still have some pretty decent contacts at USAA. And if I were an actuary, USA is the kind of firm I would want to work at. There's some things about USA that bother me a little bit right now, what they're doing, but the actuarial side at USA is just top notch, some of the best actuaries in the business. So I would definitely, you know, get to know me, do well in the class, and I can certainly be an advocate for you for USAA. There's my phone number, so feel free to call me anytime after 6 or before 10. My email, the official email is ronald.sweet. It forwards to my personal email, and I will sometimes accidentally reply to you from my personal email. So I just want you to know what it is. I'm supposed to only reply through the utsa.edu, but if you're doing something that's, not all that class specific or grade specific, I might just reply to you from the Mahler 6. But feel free to call and talk to me about class stuff or career stuff anytime. Here's the layout of the class. We're going to spend a few days on the economic basis of insurance, which is really, to me, the most interesting part of this class. It gives us a chance to take some of the finance you've already learned and apply it very specifically to insurance, especially property casualty insurance. And then you're going to notice we're just going to do product by product. So homeowners, auto, commercial. Oh, there's actually a typo there. I should switch these two. So we're not going to start commercial and go back to personal auto. So those two got switched. Workers' comp, we won't spend too much time on that. We'll talk some on that. Then we'll get into pricing. Those took my life insurance class. The pricing was really straightforward, pretty simple formulas. Most of y'all did really well on the exam on that. It's not quite so pretty on the P&C side. You're going to see it's a little more tedious. I built a model that I've used to teach this. I showed it to a pricing actuary at USAA, and she said, "Oh no, that's wrong. That's wrong. Here's the formulas." But unfortunately, the formulas she showed me, I can't do undergraduate. They're just too much. I used her formula and I used my approach, and I got the exact same answer she did. So my approach is not wrong. It's just that her approach was to use a formula to get the number. My approach is to back into the number because you know what the end result is. And you say, what number gives me that ending number? So it's trial and error. But that's just a lot easier, and you'll see that. And I will talk about how we'll actually use that on the exam. We'll do some on the accounting and ratio analysis. I'll spend more time on this than I did in my life insurance class. We will talk some on investing if we have time. We should have time. This is something that was a big part of my career at USAA. I got a phone call one day and they said, "We're starting this new department and they want you in that department. And if you say no, your career will be ending. So you better say yes." It was essentially, I didn't have much choice. And we spent an entire year doing nothing but studying how should property and casualty insurance companies invest. And is a topic that is very poorly researched. There's very little out there. And most firms really are just guessing. I was looking at a firm here in town Their CFO came to me to look at what they're doing, and I was shocked at how badly coordinated it was. It was just really messy. A lot of it was political. They were investing based on connections they had with board members, which is really bad. So we'll talk some on that. And then the rest of the semester is just some special topics. We'll probably spend some time on regulation of insurance here. We ran out of time on the life insurance class. It really is a very important topic. Insurance is a heavily regulated industry, so we'll probably spend some time on that. As far as the actual class, 2 exams and 2 papers. Everything's 25%, just like my risk management class, those that are taking that. The 2 exams, both of them will be a combination of essays and math problems, and you'll have YouTubes that do all the math problems, so you'll be able to practice that. It is kind of a problem that we cover something mathematical in a class, and in exams like 4 weeks, 5 weeks later. So you have the YouTubes, you can go back and refresh yourself, so it's not quite so distant. Pretty straightforward exams. I'll tell you exactly what's going to be an exam in advance. They're not easy topics. Some of y'all had me before. Some of the essay questions can be quite convoluted because you're dealing with some pretty complex concepts, but you'll know what it is. You'll have it in the notes. You just need to put it into your own words. And then 2 papers. The first paper is an article I'm going to give you, a very old article. The reason I don't use something more recent is because of the year it was written. It was such a really important year. So yeah, it's 20 years old, but you'll see why I used it. It really works well. It works really well for this class and getting us into the concepts, and it's not really that dated at all. And then in this class, it's the only class I do this in, so you get to pick the topic for your second paper. I'm going to give you a lot of ideas. This class, because P&C does so much, this class really lends itself to a student-chosen topic, and there are a lot of them that are really fascinating. And so I'll give you some examples of what students done in the past. I hope some of you will come up with your own topics, something new and interesting. One of the best papers I've seen in this class was the impact of COVID on property casualty insurance. That lady just, wow, she just really got into it. Just exceptional paper. I actually got her permission to send that to a friend of mine in the investment world who does property and casualty companies, and just to show, hey, boy, she really got into the details. So I'll help you more with that. You don't need to really worry about that, although you should certainly be out looking for a topic, being aware of it. So if you see one, you can start collecting data. Attendance is very important. So once we're back on campus, you need to be in class. I'll allow you to have 3 makeups using the Zoom and submitting notes, but you can't make this an online class. UTSA is just not going to allow it. If something major comes up, call me. We'll talk through it and see if there's some way. I'm not heartless if something major happens, but you're going to need to come to class. I know last semester I was much more flexible, and many professors more flexible. Maybe there's some that are going to do that this semester, but they're violating very specific UTSA rules that you cannot convert an in-class class to online just because some students don't want to come to campus. So they're strictly telling us that. So I'm sticking with it unless I get some kind of permission not to. I prefer you be in class anyway. I know it's a 9 o'clock class. It's really late. So yeah, it's kind of rough, but I mean, that's the way I was actually shocked when they started doing 9 o'clock classes. I thought it was a joke at first, but it wasn't. They really were doing that. And then if you do the instructor survey at the end, you get an extra 1%. All right. So any questions on the grading? So what I want to do is get you started on this first paper, so you know where we're going. And the real key is that you just read, you make sure you read the paper. So, so it is out there. I thought I had copied it. I have to look. I thought I'd done a copy where it was only the pages we need, but we're going all the way back to 2001. Why would I go to 2001? Anything happened in 2001 that's of any interest to property casualty insurance? Can y'all think of anything? Mitchell, can you think of anything in 2001?
New York.
Yeah,
towers.
9/11. Berkshire Hathaway lost. Obviously, losing a lot of money wasn't the biggest thing with 9/11, but it was a big deal. Berkshire Hathaway lost a lot of money because of 9/11. Now, I don't know if y'all know Warren Buffett or familiar with him. He writes some really interesting things in his annual report. So that annual report, he decided to write, if you go down to page, I think it's page 6, the bottom of page 6, numbered page. You see it says page 6, but the actual PDF is 7. But the actual numbered page 6, you have this section that says the economics of property and casualty insurance. First topic in our class, the economics of property and casualty insurance. He has written this thing again in subsequent annual reports, but much more summarized. So rather than giving you his 2018 or 2019, I've stuck with this one because he does it most detailed here. I've read the more recent ones and it's the exact same stuff, just not near as much substance. So don't feel like, I'm just keep using the same paper over and over again because I'm lazy. It really is. This is the better version to use. It really is. So what you're going to do is you're going to read from bottom of page 6 through the top, I think page 11, or nope, through the top of page 12, number 12, right up to where it says sources of reported earnings. All right, so I may not have created this one. Sometimes I'll do a PDF that's just the pages we need. We're going to get into this in class, but I don't want to do it this week. I want you to have read the article first. So this weekend, that's your job for this class. It's not that long. It's only 6 pages, and it's not a tough read. Warren Buffett does not write overly technical things. He's trying to communicate. He's a very good writer. He keeps it at an understandable level for people who don't have a background in insurance. But there's certain topics that you're going to have to really get into. He uses this concept of float. What is float? What does it mean for the business? And it's not all that clear when he uses the word float, what he means by float. One thing to keep in mind on this paper is part of this paper's grade is you're going out on the internet and finding some other source to talk about this topic. So if you see something that's really interesting to you, you might Google something and see if you can find something that adds to what he's saying. So keep that in mind as you're going through. You say, wow, that's really interesting what he said right there. I wonder if I can find something more recent on that. And sorry, I always lose my voice the first class back. It takes my voice a while to get back. So there is some terminology in here like underwriting loss and float and those type of things. So what is float? Is float an asset or is float a liability? So you have to figure that out. If you're a Geico insured, you buy your insurance from Geico, he's going to tell you you're not a customer. He's going to tell you in this paper that you're a cheap source of capital. That's what he thinks of you. Is that a bad thing? I don't know, but he thinks Geico is a cheap source of capital because he's really borrowing money from his Geico policyholders at a really cheap rate. Actually, he thinks he's borrowing money from you at a negative interest rate. How much would you borrow if you could borrow at a negative interest rate? I'd borrow a few $1 trillion, right? Invest it at 0.1% and make a fortune. That's essentially what he thinks of the Geico customer. He thinks of Geico customers as cheap capital. He can borrow money at a negative interest rate. So you can already see when we talk about the word float, his term for float is it's another source of debt that he can get that's not in the market that he thinks is really cheap source of debt. Well, what happened in 2001? Well, in 2001, his cost of float skyrocketed because of 9/11. So the first part is understanding this concept of float. And he actually shows you float here. See if you can understand what this is. He's actually saying float is something you can find on the balance sheet. So what is he says this is year-end float, but what are these numbers actually? See if you can figure it out from what he says. I'll let you know when we get into class. If you can figure out from what he said, that would be really, really good. So he's got Geico, Gen Re, other reinsurance, others, but Gen Re is the biggest part. We think of Geico because of all the commercials. Gen Re doesn't advertise, but you can see Gen Re is the largest. And they have other reinsurance companies. You can see that's where they had their losses. You can see that these numbers jumped. So that's the bad thing for him. These numbers jumped. So what does that mean? What is $8 billion jumping in and this float, what does that mean? Then he gets into the meat of the paper. So he's defined what float is. He says it's absolutely central to insurance. Then he says, what are the principles that help us control float? He gives you 3, but there's a lot more than 3 in here. The third one is the third one. The third one's the easy one. But the first 2, I think I come up with 6 or 7. So as you read through this, what is there in there? We'll go through this after you read it. So maybe next Tuesday, we'll spend some time on this, really set you up for this paper so you can really focus on the paper and not have to worry about anything else in the class. Just give me a really good, meaty paper. But what is it, these principles that he's saying, and why is there more than one in some of these numbers? So number 1 might be 3 different things. Why does he put all those together? And then he has a 4th one. And this is where students do the worst on this paper. He talks about experience versus exposure. And most students, I think the average is probably 40, 50% on that part of the paper. And every semester I say, you got to do better. You got to do better on this in previous classes. And every semester it's the same. So I'm going to keep trying my best to help you understand this experience versus exposure. Maybe I'll spend more time on it this time and repeat it a little bit. What does it mean by experience versus exposure? And then he talks about the 2 types, the 2 ways experience can lead you wrong. And you need to talk about those 2 ways, and very specifically. A lot of students completely miss that. And that's 20% of the paper. So it's really pretty critical you get this. I think this is actually one of the best parts of the paper. So we'll get into that. Here's what we do know. I actually disagree with him that. He's saying there's some things that we absolutely know that I'm not so sure we actually know. So we'll get into that list there. He does talk about reserving. So this part about on reserving is actually not part of the paper. So I just want you to read it because it's interesting. It will come up later in the class when we talk about reserving, but it's not part of this paper. So I'll let you know, that part of the paper you can ignore it as part of the article. However, I do want you getting into this last section here. Oh, actually, the loss development here. I'm sorry. Here's the loss development part. I do want you to read this section, but it's really not part of the paper. All right. So the last really important section is this top paragraph on the top of page 10. And this is a big chunk of the paper. I think it's like 10% of the paper. You're going to get my biases, and I've had students agree and disagree with me. So I don't really care if you agree or disagree with me. I kind of almost like it when you disagree with me. But he said all this stuff for several pages on underwriting discipline, making sure you know what you're doing. And then you get to this paragraph. Ajit has been particularly busy. We have written jumbo risk. I read this paragraph, and you can get my bias. I think there's something missing in this paragraph, where he somehow equates this paragraph to everything he just said. Because he's been talking about we got to manage risk more carefully, got to have more knowledge of what we're doing. Then he comes to this paragraph and says, man, we've been adding risk to our portfolio like crazy. At rapid speed, we can hardly keep up with it. Does that seem consistent with everything he just said? So I want you to spend some time. I mean, look at this. How does he start this next paragraph? Does that sound like something that someone who's worried about managing risk well? No one can match the speed with which Ajit can offer huge policies. So I want you reading, and should he have not put a few caveats in this section here? Now, some students say he does. There are things in here where he does caveat it. You can see like this last paragraph, we have attempted to avoid writing gruesome policies, which might seriously aggregate. We're going to talk about that aggregation. All right, so that's really down to right about here is really where you're going. The rest of this is just interesting stuff. So read this, we'll get into it. The rest of this later in the semester. All right. So this is your focus right now in this class. Just focus in on this article. It's not that many pages. read it, and then remember a good chunk of the paper, 10% of the paper is other. Finding something in this article that you can do your own Google research on and bring it into the paper. And there's several aspects of that you can certainly do that other students have. Ajit is still there, and he's actually pretty well known as probably maybe even the replacement for Warren Buffett. So, you know, he's a well-known guy. Very smart guy. Obviously, I think he's an actuary from background, which, you know, by definition means you got to be pretty smart because the math requirements there. All right. So this section here on page 8 is where students do the worst, where the word experience starts. Slow down when you're reading here. Let it sink in. Think about it. You might pull up an annual report from Warren Buffett from a more recent year and just search on the word experience and exposure and see if he said anything more recently that's a little clearer. I'm going to tell you more. I'm going to add stuff that he doesn't talk about here. He just kind of alludes to it. So I'm going to be much more specific. He alludes to it in his examples. He gives examples, but his examples are actually showing you two different things. And a lot of students completely miss that there's two different types of experiences he's talking here, because he doesn't say that. He just gives two examples that are radically different and doesn't tell you why they're radically different. So we gotta get into that. All right, questions on that? I think you'll find an interesting article. He is a good writer. All right, let's get to these. So one thing you want to get off of Blackboard is the class notes. So if you go out to the content, you should get the class notes. I don't teach from PowerPoint, mainly because I don't want two sets of the same thing, PowerPoint and class notes. So I go from the class notes. It can get a little busy with all the text, so I'll try to make it real clear where I'm talking and try not to go too fast, or make, let you know exactly where I am in the notes. That way you can take your notes in the notes, and it gives you one place for everything. One thing I will say, if you're going to make up an absence, so you get those 3 absences that you can make up by watching the Zoom. If you're going to make up an absence by watching the Zoom and submitting your notes, make sure you submit notes. Don't just submit my class notes to me. If I covered pages 6 through 9, don't just send me class notes pages 6 and 9. I'm not going to count that as a makeup. You got to convince me that you watched the class and you took notes. And there are a few places in the class where it's not a whole lot of notes to add because we're just looking at contracts, but do your best to add stuff. Put comments in there so I can tell you're engaged the entire class. All right, so a little bit more on paper 1. 40% is covered, so you covered all those items, and there's essentially 10 items you need to cover. Clarity, we'll talk more about this. I'll give you some examples of papers of how I like clarity. I hate double-spaced papers. I just think they look like college student papers. Try to make it professional looking as you can. I'll give you some examples of that. Watch your paragraph length. Use quotes. Quote it. Make it really clear that's a quote. A lot of titles and bolding. Just make it really clear the organization of your paper. We'll get into that more. Critical thinking. It's things like this. What did you find interesting? What surprised you? What did you question? What are you curious about? That's where some of your extra research come in. What else should they maybe have considered? Maybe Warren Buffett left something off the list. Outside reading, that always helps in critical thinking. I'm essentially requiring you to do that on paper 1, and in paper 2 is 100% outside reading. And then if you're not sure of something, do your best, but even better, just call me. We can talk about it and make it a little clearer. So that's the kind of thing you're looking for in this first paper. I'm going to, in the class notes, you'll notice in the class notes, there is an outline for paper 1, and we will go through it in detail. I forget where it starts, somewhere in the class notes. Yeah, on page 6. I think you're better off reading the article before you look at this outline, and then maybe look at the outline and go back and read it a second time. Since it's only 6 pages, it's not going to take you that much time to read it. All right, so we will go into it in detail probably next Tuesday. So make sure you've read the article by next Tuesday, because it's really going to harm you. You're not going to do as well on the paper if you're listening to me and you haven't read this stuff yet. I also hope you'll have some feedback because I think there's some pretty interesting stuff, maybe not overly controversial, although some of it could be controversial. All right. Any questions on paper one, what you need to be doing this weekend? You only have one thing to worry about in this class right now.
So can you just clarify the pages? You said the end of page 6 was where we should start reading.
Right. It says the Economics of P&C Insurance, right?
Where should we read to?
The top of page 12, although pages 11 and 12 are really not part of this paper.
Okay.
The paper really stops the second paragraph of page 10. I'm talking about the numbered page, not the PDF page. So the numbered page, the second paragraph. But you'll find, especially as an actuary, Linda, you'll find page 11 pretty interesting. He's talking about some stuff that's really pretty important for us to understand.
Thank you.
And I think the paper description does that as well, gives you that information. All right, paper 2, what could you do on paper 2? Here's where I hope some of y'all get excited about this because there's a lot you can do. So cybersecurity is a big issue. I've had a few students write a paper about what is insurance going to do with cybersecurity. Autonomous vehicles has been a big topic. It's obviously not moving nearly as fast as the industry thought, but there's a lot there. Terrorism has been an issue. It's not written about as much recently, but you could certainly say terrorism. Obviously, after 2001, there was many articles written about insurance and terrorism. Just topics, just strange topics like insurance doesn't cover war risk. Well, why did President Bush call post 9/11 the war on terror? Oh, well, was 9/11 a war? If it's a war, does that mean they don't have to pay their claims? Stuff like that. There's some issues that came up with 9/11 that we'd never had before. You had to go to court. Regulation of auto insurance. We're actually going to read a pretty old paper on that, but I just can't find a better, more recent one. But there probably are some more recent ones that are pretty interesting. I keep looking and looking, but I just can't find one. The article I use is by Steve Darcy, and he's one of the best actuary writers out there. And I don't think he writes anymore, so I just can't find anything. Global warming has been an interesting one. What is global warming doing to the flooding and hurricane strengths and those kind of things? Affordable Care Act, I haven't had anyone write that, but there are some topics on workers' comp that are certainly very specific to workers' comp that you could get into. That's not my field of knowledge. I used to do this road show where I presented at conferences, and there was a panel of 3 of us that presented, and one of the people that presented with me was a lady who did workers' comp. And most of my knowledge of workers' comp I learned from her and all those presentations we used to do. But it's not my area of expertise. COVID and the impact on the industry, that is an interesting one. It's getting a little old now. One I think is really interesting is the gig economy. One thing you might do here I think is really fascinating is there's a new insurance company called Buckle. Have y'all heard of them? So Buckle, they're offering insurance to Airbnb and Uber drivers, a really much needed insurance. We've had, they've been hiring UTSA students. I used to work with the CEO of Buckle. And so they emailed me and asked me for some students. So I sent them several students, and they've really liked our students. I don't know, some of y'all know Bon Wiseman. He just started working with them, or Bond. Oh, I forgot his last name, but Bond. One of the ladies in my risk class from last year got a job there. So Buckle's an interesting company that's actually, so this is something where you could probably go to their website and find a lot of research to help with the paper. It'd be really fascinating. There are others that you could do, but one of the great things to do is there are websites I find really excellent. So RMS and AIR. RMS are the 2 catastrophe modeling firms. They model hurricanes and earthquakes and terrorism risks. Their website is full of research that is really interesting. So if you want to do a paper on global warming and its impact on the industry, RMS and AIR would have a lot of stuff there. Swiss Re, if I were an actuary, I would want to work for Swiss Re. We had a meeting with Swiss Re when I was at UTSA, and I just sat there going, boy, this is the company to work for. These people are so smart. They're so thoughtful. They're very friendly. They're just constantly asking, what if? why, how can we do this better? Just it's like you're sitting in just this scientific kind of laboratory, constantly asking questions about how can we measure this better? How can we understand this better? And they have some really, really good research on the website. And there's several others that we'll see as we go through this. One I think is really, really interesting that we'll cover later is the Insurance Institute of America, or I forget the exact title. We'll see it, but it's the institute that does. Y'all seen these crash dummies? They used to have a commercial in the U.S. with crash dummies. There's a really great commercial. It's kind of out of date now, but the crash dummies in this institute, they do testing of vehicles for safety. And their website has a lot of research. We're actually going to watch a couple of their videos for our class. I'll actually, instead of having class, I'll have you watch the videos and come back with your notes. So they have a lot of really, really interesting stuff. One topic I think is really fascinating is how the insurance industry has impacted the construction of automobiles. I don't know if y'all know who Ralph Nader is. I think he's still alive. I should look that up. I mean, he's getting up there in age. He's probably in his 90s by now. Y'all ever heard of Ralph Nader? He ran for president. He may have been the reason Gore lost the presidency against Bush because he picked up enough votes in Florida that caused Gore to lose. But he's all over the place, but very interesting guy. If you Wikipedia him, you will see he's the guy that got cars to have seatbelts. That was his big thing. He saw these cars were just killing people and he pushed it. But the insurance industry itself is doing the research that's causing airbags and side airbags. We're going to look at one video later where we're going to look at a 1950 car and a 2010 car and see them test. And you'll be surprised. You'll look at that 1950 car and say, man, that thing's a tank. Nothing can damage that. And then you'll watch the test and you'll be really shocked at how much safer cars are today. Much of that is the insurance industry. The insurance industry is making us safer and safer and safer. So there's a lot you can do there. You can look at one topic I don't think anyone has written about, but I would find really fascinating is distracted drivers. What is the iPhone and all that kind of stuff doing to driver safety? And the Institute of Highway Safety, that's what it is, Institute of Highway Safety. They have a lot of research on distracted drivers. One other thing I find really interesting, I'm going to show you some of these, but it's a video called The Worst Driver in Canada. Have y'all seen that yet? It's a competition show where they're trying to figure out who's the worst driver in Canada. It's funny and scary and sad. So you might look for some of those. I'm going to try to find a few clips from that. And what I want you thinking watching those clips is those drivers are out there. This one guy they showed, he was constantly on his phone and constantly having accidents. And as a result, he broke his arm. So now he's driving with a cast. And guess what he's doing? He's on his phone constantly. But he can hardly do it because he has a broken hand. So now he's driving with a hand with the cast in it so he can watch his phone in the other hand. Those people are out there. They probably shouldn't be allowed to drive, but they're out there. And so some of these videos are funny, but at the same time, you're thinking, my word, that's the person on the other side of the road coming at me at 10 o'clock at night. The other thing I'm going to show you is bad driver videos. There's a lot of them out there. I find them fascinating. I'm going to talk through that. If you watch, I don't know if any of y'all watch some of those. YouTube has a bunch of them. If you watch 3 or 4 of these, you'll suddenly come up with a list of 5 things that are the main causes for accidents. And what it's done for me, it's made me a much better driver. I know where those areas are where most of the accidents happen. And I've changed my driving dramatically in those areas. I mean, none of y'all want to be in a serious accident, right? You don't want the physical damage to your car. You don't want the physical damage to your body. You don't want to be the cause of someone else getting injured or dying. And the nice thing is It doesn't mean you have to be like driving, like the perfect driver, not 100% of the time. There's really about 5% of the time where most of the stuff happens. And that's when you need to click back on and be very, very cautious. So we'll talk about that. So there's a lot of that kind of thing that I think is really, really interesting. And a lot of it comes to distracted drivers at the worst possible time. And these accidents that happen. And some of them are really brutal to look at. But those are interesting topics, I find. And I'm sure there's many others. So try these websites out and some of the other websites that I'll show you that are really, really fascinating. So the Institute of Highway Safety, let's see if I can find their website and I'll put it in there. They're very interesting. Institute of Highway Safety, there it's IIHS.org. I've been at conferences where they present, and they're always the most popular presenters because they're doing research they're funded by the insurance industry, and they're doing research on head-on collisions, side collisions, head-on collisions where the cars hit hood to hood, head-on collisions where they hit at an angle, back collisions, airbags and the harm that airbags do. You have airbags where they say, the airbag has been turned off because of the weight of the person in the seat. The damage that airbags is doing to people. You might find, looking at their site, that you might influence the next car you buy because they do have safety ratings, and they also have videos that show you in one car versus another car, and they say you have this accident in this car, you're walking away. You have an accident in this car, you're going to have multiple fractures in your ankles and your legs. You'll be going out in a stretcher. And they understand why. Why is it that one car is so much safer than the other car? So we'll look at that. We'll look at the website, but there's a lot to work with there. So I'm not saying you need to pick your topic now, but the earlier you pick it, and you have it in mind, and if you see something on the news channel, or you see an article, or you see something somewhere on social media, you can grab the article and make it part of your analysis. One thing, be real clear on paper too, it is not a research paper. So research paper, you're going out there getting 20, 30 articles. This is the type of paper, if you found one or two really meaty articles, that could be enough. Maybe an article that's 7, 8, 9 pages long, really in depth, and then maybe a little bit of supporting research around that. So, it's not a full-blown research paper. It's a paper that's going to go, 4 to 6, 7 pages, something like that. It just depends. If you double space, double that. So it's not a research paper, but it is something you want to have some really good analysis on, and something that you find interesting. If you're an actuary, you might want to pick one that's really related to actuaries. So I'm trying to think, I haven't looked at the casualty actuary. It's CAS, y'all know that one? Casualty Actuary Society. I'm not sure what's on their website, but it's casact.org. They may have some stuff on their website. They do have publications and research on their websites. So Casualty Actuary Society, actuary, what I really encourage you to do, especially if you're an actuary, but for all of you, pick your paper 2 topic that's going to give you some real strength in an interview. If you're going to interview with an insurance company, like let's say you say, wow, that Buckle company sounds really, really interesting. I want to interview with them, then go research that. Another company that's really, really interesting. So you got Buckle. Another one that's really interesting is called Root. Root is insurance by AI. Really fast. I've been really tempted to buy auto insurance from them just out of curiosity, but they do everything by AI. They put that computer on your car. They test how well you drive, and based on that, they give you an insurance rate. Very interesting firm. You could go to their website. There's actually a podcast. I have to find the podcast. I can't remember it right now. I might be able to find it on my phone, but there's a podcast that talks just insurance, property casualty insurance. Really interesting, fascinating. And they actually had Root on their podcast, and it was very fascinating to hear them talk about that. But yeah, I think it's a podcast. It's called Not Unreasonable.
The opinions and statements expressed in this podcast.
So Not Unreasonable. And you could probably find the interview with Root. Very interesting. So if you're interested in AI and data analysis, there's a firm, rather than hiring a bunch of underwriters, they're doing it all with data. Would be a really interesting topic, wouldn't it be? How do you put it? And another thing is, I already forgot the word. Telematics. Are y'all familiar with telematics? I kind of mentioned that. So they hook a computer to your car. They see if you're doing jackrabbit starts, and doing quick stops, if you're speeding, changing lanes a bunch. That's kind of what Root is doing. But telematics itself, I have had some students talk about telematics and the impact that has on the insurance industry. I've always been tempted to have USAA put telematics on my car because that's where I buy my insurance, but I just never get around to it. You know, I bought a new car in December 2019. I've only put 6,000 miles on the car. And so my rate should be much lower than it is because I hardly drive. And so I'm thinking telematics might, it's, Lindy, that's what I heard. It's pretty simple to do. And I'd kind of like someone to tell me how good of a driver I am, because people who ride with me tell me I'm a terrible driver. I want to know if they're just nervous or I'm really a bad driver. So, which is kind of nice because people say, hey, can you give me a ride? I say, yeah, I can, but people tell me I'm a terrible driver. So, and they're like, oh, well, never mind. So it's kind of gets you out of stuff. But I mean, there's a lot of stuff here. So think about this in terms of not what's the simplest to write, but think about this in terms of what's going to help you the most in a job interview. Give yourself some good fodder for, you know, these type of companies that ask questions, and they're shocked when students can go into detail on these type of issues. We're going to get to that when we talk about auto insurance and credit scores. We're going to talk about stuff that most undergraduate students don't get into at all. So I'm trying to set you up so you can really sound different than other people competing for those jobs. All right, so you can ignore this until, you know, after the first exam, but I encourage you to at least start thinking about it now. You don't have that much to do in this class except for paper 1, so you might as well start thinking about paper 2 at this point. If you have questions about topics that you see, you think that would work. I had one student do a topic on the on these scooters that you can rent and leave everywhere. It was an okay paper. I just don't think there was enough to work with on it. So, you know, there's some topics I don't think there's enough data out there to really research it. All right. So where we're going to go from here, we're going to get into economics of P&C insurance. And there's really 2 really big things we're going to address here. And so keep this really clear in your mind. We're going to address the issue of when you as an individual should buy insurance. And then we're going to address the issue of when can the insurance industry insure something. So when does it make sense for you to spend money on something that's called insurance? And when is insurance a viable product for the company? So there may be places where you wish you could buy insurance, but it just makes no sense for the insurance industry. And there are a lot of places we're going to talk about where the insurance industry sells a product that I don't think you should buy. Now, I'm hoping I can set up a really good debate on this. I'm trying to get someone from State Farm to come on. I hate Part B and C of auto insurance. I don't buy it. I never buy it. I think it's a waste of money. I argue that every semester, and I lose that argument every semester. I just think it's a complete waste of money. I had a big argument on Facebook with a lawyer. He thought I was an idiot for thinking that, but I strongly disagree with him. I'm going to give you my argument. I don't think I've ever convinced any of my students that I'm right on that, which is fine, because I don't want you to cancel B and C and then suddenly you have a claim the next day and you're like, wow, professor, you just lost me $400. I think it's a waste of money, but I want you thinking about that. That gets in the area, when should you buy insurance? I think B and C is a waste of money, not because it's not going to provides you some protection, but it's because you can spend that money so much wisely somewhere else. There's much more valuable places to spend that money, in my opinion. We'll see. I don't know how many of you, in fact, I wouldn't be surprised if the majority of you have B and C and don't know it. Is that true about anybody? You have auto B and C coverage and you have no idea that you have it? Is that possible for some of y'all? Most of my students say, yeah, I have no idea if I have it or not. The answer is, if you don't know if you have it or not, guess what? You've got it. Because it's just the standard way it's sold. In some states like Colorado, you have no choice. You have to buy it, which really doesn't make sense to me. So that's it. Those are the two questions. When should you as an individual or a corporation buy insurance? When should the insurance industry actually sell insurance? Yeah, so check your policy. That's one thing you might want to do when we get into the auto insurance. Maybe get your policy out and just read it. If you've never read your policy, look at it. We're going to talk about rate online. I use rate online all the time. I don't want to spend money on insurance that's covering something that I shouldn't be insuring. All right, so there's the two questions. Now we're going to break up the first question into two pieces. So the first question is, when should you buy insurance? We're going to break that up between individuals and corporations. And you're going to find that the corporation answer is very different than the individual question. All right. So when should individuals buy insurance and when should corporations buy insurance? And then the industry side is, when should they sell insurance? That's really going to be the same, whether it's individuals or corporate. And guess what? That second question is exactly what Warren Buffett's talking about for paper one. So you're going to get that twice. I'm going to talk about it, but you're also going to see it. And you're going to see a lot of my discussion and Warren Buffett's going to overlap. So I'm going to try to consolidate that all into one big discussion. So y'all see where we're going? So the answer to that question, one thing you have to really make sure you understand are the concepts of severity and frequency and severity. Warren Buffett will talk a lot about it. You cannot write paper one without the words frequency and severity somewhere in the paper. So frequency is a probability, severity. There's several different ways to define it, but we usually think about severity as your average claim. So frequency is the percentage of claims or number of claims. Severity is the average claim. We're going to talk later in the class about the pure premium. We're actually not going to calculate a pure premium. We're actually going to calculate the full premium. But the pure premium is how much of your auto premium is just covering your losses. Doesn't include the expenses the company has and their profit. You're going to see pure premium when we look at credit scores. Pure premium is just how much of your premium just covers what the insurance company is paying in claims. The total premium, they're going to add on expenses and they're going to add on profit on top of that. All right, so that's the pure premium. The pure premium is frequency times severity. So if you have a 22-year-old male driver driving a, I don't know if there are any 8-cylinder cars, but a red sports car, their frequency is going to be really high and their severity is going to be really high. 22-year-olds, y'all know your rates are going to drop when you hit 25, right? Magically, the first second after your 21st birthday, you suddenly start driving a lot better. At least that's what the actuaries think. But at 22, male driver driving a sports car that's red sports car drivers are more dangerous drivers than blue sports car drivers. You see what actuaries do? They look at everything. They're data mining enthusiasts here. And so that driver is going to have a higher probability of loss. Let's say 2%. That might be a little high, but 2%. So there's a 2% chance they're going to total their car. If their car is $50,000, then the frequency is 2%. The severity is 50,000. So on average, they're expected to lose $1,000. So what's the insurance company going to charge? They're going to charge at least $1,000. There was a book I looked at that I said, you know, maybe I could use this book for my insurance class. It was called The Economics of Property and Casualty Insurance. But early in the book, they said the reason insurance works is insurance companies charge less than the expected loss. That's not true. They can't charge less than expected loss or they go out of business. you can't charge this person $800 because if you have 1,000 of them, this is going to be your average loss. If you're charging them each $800 and on average you're using $1,000, you're not going to make much money doing that. So I gave up on that book right away. It's like, I don't know who wrote that book, but it wasn't an actuary. So insurance is a losing transaction. You cannot do a net present value of auto insurance. The net present value is always going to be negative. You're always going to pay more in premiums than you're going to receive in claims. Unless it's just pure luck, right? You buy the policy and the next day you have a major accident. Yeah, then you come out ahead. But on average, your expected value is always negative. Why? Because the insurance company is going to charge you the net present value, what they expect to pay you, plus their expenses plus the profit. I think that's absolutely critical, because what that means is insurance is a bad decision most of the time. You want to avoid buying insurance unless it really makes sense. How can you make it really make sense? You've got to get frequency really, really low as possible. When frequency is low, the company's expenses are really low. So they don't have to charge you so much for expenses because they're not doing much, right? You don't file that many claims. The severity can be high, but as long as the frequency is low, it works. So that's what we're looking for. So insurance is priced so the policyholder on average loses, because that's the profit and the expenses of the insurance company. Insurance is an inefficient industry by design. Insurance companies have to hire people no one else has to hire, and they're very expensive people. Which y'all are glad they're really expensive people, right? You actuaries are glad that you have a very high paying job. Actuaries, underwriters, investment professionals, other experts. There's people at UTSA that you just don't find anywhere else. Engineers. UTSA has engineers. There's a basement at UTSA, and these engineers, they set kitchens on fire all day long. So someone calls in and says, hey, I had a grease fire, burned my kitchen, but you know, I started the oven, and boy, the fire caught on just 3 minutes later. I wasn't going that far. They go into their basement, they try that and say, no, you weren't away for 3 minutes. You were away for at least 20 minutes. There's no way you started the fire in 3 minutes. So they're hiring engineers, they're hiring weather experts. They have people that no other firm needs. If you look at Swiss Re, my word, Swiss Re, they have a lot of meteorologists on their staff. They've got a lot of engineers on their staff. They don't just hire actuaries. So, you know, these are high cost groups because they're doing stuff that's really quite complex mathematically. So when should you buy insurance as an individual? So this is the key here. We're talking about individuals. So we'll get into that. Then we're going to ask the corporation side. And this is going to be a question on exam 1, where I'm going to ask you to go back and refresh yourself with CAPM. If you don't remember CAPM, hopefully you remember it. Ryan, you remember CAPM? Yeah, good. You're a finance major, right? CAPM, you've had it 2 or 3 classes. I don't know, Lindy, if you actually see CAPM much, but CAPM, very, very important stuff. I was responsible for helping the actuaries with pricing their insurance products, and we used CAPM. And I went into a meeting of a bunch of property and casualty actuaries, and they knew CAPM as well as I did. We had a great debate. It was really fun. I had so much fun with these actuaries. If I go into a room with the finance people, I'm not sure it would have been nearly as fun of a discussion. Really smart people. They knew CAPM. I think it's on the exam one day, probably at some point. So we're going to talk about it. You may be surprised at what CAPM actually says about corporations and insurance. And then we're going to talk about the insurance companies, and that's where the Warren Buffett comes in. All right. So y'all see where we're going over the next few classes. The first one's going to be pretty simple. I covered it in my life insurance class. The second one is the wicked question on exam 1. So you need to really pay attention so you can get a really good answer on that. And then the third question is your paper 1. All right. So I'm going to stop it there. So you know where we're going. Thursday night, we're going to really address this first question and probably get started on the second question. Next Tuesday, we're going to do the Warren Buffett, so you can really get started on that article. I mean, on that paper, you should already read the article. Everybody knows, read the article before next Tuesday. All right. Any questions about what we're going to be doing next few classes? All right, I'll stay on if you have any questions or comments. I'll turn off the record here. So let's get into the notes. We got some, I think, some pretty cool topics. If you can go on video as I try to get to know who you guys are. I know about a fourth of this class, maybe a third of this class. All right, so we're getting into the economics of insurance. Just keep it really clear. Maybe have it in your notes or somewhere. What we're trying to do is answer these three questions. What is the characteristic of risk the individuals should buy insurance that hedge that risk? What's the characteristics of risk, and really what characteristic equations that determine where they should? So it's a little bit different question. I should have highlighted that. For individuals, the question was, when should they buy? Corporations, it's not when. We're asking the question, should they even buy insurance at all? It's a very different question. And then for insurance companies, when can they sell insurance? All right, so when should individuals buy insurance? Should corporations buy insurance? And when should insurance companies sell insurance? And there I'm not going to break between individuals and corporations because it's really a very similar one. And on this last question, the third question, Warren Buffett is a big part of that. So you're handling that in paper one. Make sure you read that article before Tuesday class because we'll definitely be getting into that. And you want to make sure you've read it and started taking notes before that class, so you're not coming into it blind, not knowing. We walked through some of it last class, but we'll go in much more detail. So, all right. So the first question is, when should individuals buy insurance? If you took my life insurance class, it's the same answer. It doesn't vary between life and property and casualty. It's the same. So the question is all about frequency and severity. There are events that are low frequency, low severity. There are events that are high frequency, low severity. There are events that are high frequency, high severity. And then there's events that are low frequency, high severity. Only one of those is good for insurance. So you start with low frequency, low severity. Doesn't happen very often. And when it happens, it doesn't cost you all that much. So real key when you're answering this, when you're talking about this, I can't remember I don't know if I have this on exam or not. I can't remember, but if I had this on exam, the real key here is always remember what we talked last class. Insurance is a losing transaction. It is priced to be on average a losing transaction. It's very expensive. So if on average you expect something to cost you $200 a year, the insurance company is going to charge you $270, $280, something like that. So buying insurance is going to increase the cost of something significantly. If it's low frequency, low severity, you're just, it's something that's maybe going to cost you $20 a year. So you're going to spend $25 on insurance to cover it. Worst case, maybe it costs you $100. You're better off just self-insuring that because on average, you're going to lose money. The example, I think, warranties, I always tell this story. So some of you have heard it before, but I bought a 9-inch screen black and white TV from Conn's. I think it was $16. I get up to the register and they say, do you want the insurance on that? Do you want the warranty on that? I go, warranty. He says, yeah, it's $7. I say, why would I pay $7 for a warranty on a $16 TV? And I even told the guy, if I drop it going to my car, I'll just come back in and buy another one. It's $16. Why in the world would I do that? Now, some of you are going to strongly disagree with me, and that's fine. I can't say that I've done the math in detail, but things like smartphone insurance, I can't see how that would possibly be a good idea. But if some of y'all have it, you want to argue it, tell me to go look at the numbers that you think it's there. We'll talk about rate online and what that means. Why don't I think it makes sense? Well, because people lose their phones or damage their phones all the time. So the frequency is kind of high, so it may not fit in this category. But on average, if you buy that insurance, you're going to pay more for it than what your average you're going to get back. And so it can't be a good deal just because if it was a good deal for you, it would have to be a losing deal for the people offering it. And the people offering it know the math a whole lot better than you do. And they're not going to offer a deal that's going to lose them money. So you're kind of at the mercy of people who have the data, have the analysis, know what's going on. They're the ones setting the price. So this type of insurance is going to lose you money on average. So my idea on warranties is I don't buy them. It's true if I bought a warranty on tires or bought a warranty on a refrigerator or whatever, there's going to come a time when that warranty is going to work. But most of the time, I'll never use it. So at the end of my life, if I didn't buy the warranties, on the end of my life, I'll be ahead. There may be 1 year I wish I bought a warranty on a $700 appliance that breaks down, but over my entire life, I'll come out ahead. Also, for me, there's so many things with warranties, I can't keep track of it. So if something breaks down, I'm now going to go find that warranty, and I'll never find it. Who knows where I stored it? And so to me, it's just a hassle. It's like there's things in life that you're gonna break. They're gonna break down. You're gonna have a flat tire. You're gonna have to spend $100, $150 on a tire. That's just life. Don't feel like the insurance company has to pay for that. Now we're gonna get into that quite heavily when we talk about certain types of the auto insurance. But one part of auto insurance I really think fits in this category is towing and labor. Most people buy it. I don't buy it. Most people buy it because it's so cheap. But why is it so cheap? Well, it's so cheap because it's very infrequent. Now, it's not going to cover if you have towing and labor because you ran out of gasoline. It's towing and labor for a risk that's covered by your insurance policy. So you had to have an accident or something had to happen. You had to run your car into a tree, and then you need towing and labor. It's not going to cover you if you have bad maintenance on the car, or you have a flat tire, or you have, this isn't AAA coverage. It's covering you for a peril in your policy. How often do you do that? I've never had that on a policy. I may have had one where I may have been able to use it. I actually hit something and it caused some damage, but I'm not so sure, because the reason I had to call a towing company is that it knocked out both of my front tires. I had 2 front flat tires. So there's a chance my insurance wouldn't have covered that. But the towing was like $60. Now, for some people, $60 might be severe. For me, $60 is low severity. I'd rather just insure it myself. All right, so you have to decide, are you buying insurance for low frequency, low severity events? I think you're wasting your money, because I think it's not that sometimes you might not come out ahead, but I think there's just much better places for you to put that money. The best thing to do there is retain and just practice loss control. Try to limit it so you don't, I'll try not to drop the TV set walking to my car. Maybe I'll walk a little more slowly and be real careful, but that's pretty easy stuff. What about stuff that happens all the time, but when it happens, it's not all that severe? Again, this is even the worst case, because if it's high frequency, that means the insurance paperwork is enormous, which means insurance is adding tremendous amount of cost here. So you're better off self-insuring that. To me, the best example of that is the insurance you buy for dental cleanings. If your dentist is going to charge you $100 for a cleaning twice a year, if you have dental insurance that covers that, they're going to charge you $240. Why would you spend $240 to get $200 in dental cleanings? It just doesn't make sense. So, and Ryan, you're worried I'm going to get off on my healthcare tantrum, right? But there's a lot of healthcare that fits into this category. Checkups, health checkups. You see a doctor once a year for a checkup. That's pretty frequent. There's really no reason for insurance to cover that, but insurance does cover that. And in fact, President Obama said insurance would be forced to cover that. I understand his argument, and we talked about it in my class, but I don't like that argument. I won't get into it, though. This isn't a life insurance class, but you're better off just paying that out of your pocket. So out of pocket, self-insure. Why? Again, it comes down to all those actuaries and underwriters, all the things those life insurance companies have that you're going to have to pay for when you buy insurance. And it's anywhere from 25, 30, 40% of what you're paying for. So anytime you buy insurance, you're getting coverage for the loss, plus you're paying all that stuff to the insurance company. It just doesn't make sense. But what if you have something that happens a lot and it's a disaster when it happens? So you buy insurance for that. Well, that would be good if the insurance is mispriced. If you know for sure you're a horrible driver, but the insurance company doesn't, then yeah, buy every single part of the insurance you can with the highest limits you can. That makes a lot of sense. Eventually, you're going to figure out that you're a bad risk. But until then yeah, if it's mispriced insurance, but for the most part, it's not going to be affordable. So let's say you have a $4 million house on the coast of Florida. You can do the math here. I mean, just think about it. I mean, just think about this. You got $4 million house, coast of Florida. You tell me in the next 50 years, what do you think is going to happen to that house? What's the probability that house is going to be completely wiped out in the next 50 years?
Pretty high.
Pretty high probability. So if you take 4 million and divide it by 50, that's the minimum they're going to charge you. They're going to have some time value money and other things, but you're essentially going to be paying for your house over the life of the house, because the house is going to, maybe 50 years is too long, maybe in the next 20 years, who knows if global warming is affecting it. So, you know, there's the best thing to do here, and I don't really understand why people don't do this. Don't buy a house on the coast of Florida. Go stay in a 5-star hotel on the coast of Florida and just, you know, the $4 million, you can stay the rest of your life in a 5-star hotel pretty frequently and fly over there. You don't really need to live on the coast. Maybe buy a condo, because if you're in a large condo, you're probably less severe than a house, but still, why do that? I had that same issue with people in California. They had these houses that were overpriced, and they're complaining about the homeowner's insurance. It's like, sell the house and stay in an apartment, or come to Texas and buy 6 houses for half the price. You know, it just doesn't make sense. You have a grossly overpriced house, so your severity is very high. You're in a state which has a high earthquake risk, so your insurance is really high. Why do you have that asset? It doesn't make sense to me. So my opinion in cases like that, if homeowners insurance, I'm saying don't even buy the asset. You're really wasting your time buying the asset. That's just a really ridiculous purchase to make. Or just accept the fact you're buying an expensive asset that has a high probability of being destroyed. Yeah, you're going to lose it. When it happens, it's going to be a loss. You'll just have to live with it. I think it's funny to people in Texas, and some of y'all heard this story before, but people on the Texas coast, they said, I know what we can do. When a hurricane comes in, most of the damage is storm surge. We're going to talk about storm surge. I know what I'll do. I'll put my house on 20-foot stilts. Then when the storm surge comes in, I won't be harmed. What they didn't realize is when you have your house on a 20-foot stilts and your neighbor's house that's not on stilts gets destroyed and comes floating by your house on stilts, guess what happens when your neighbor's house runs into your house on stilts? Your house on stilts comes collapsing down. And I remember the guy who he did a documentary on this, and he saw many houses were destroyed, not by the flood, not by the wind. They were destroyed because they're up on stilts, and another house came by and knocked their house off the stilts. So, you know, it's, to me, the best thing to do is just risk avoidance. Sell the house and move, or rent. You know, there's things to do. You can rent some pretty nice stuff for the same price as a $4 million house. I don't know why owning something is all that big of a deal, especially if there's high risk. You know, to me, you can do the math of renting or owning, but then you better throw in a massive amount of homeowners insurance on top of that, and that might really skew it on the side of the renting. So very sick people buying life insurance, well, essentially it's too late. They should have bought the insurance before they were sick. Building a house in a floodplain, 16-year-old drivers. You might argue that a 16-year-old driver, I did my parents a really huge favor. I didn't get my driver's license until I was 18. I probably saved them a few house payments there. You know, it is an issue. Young drivers are terrible drivers, and you know, the insurance is, you know, it's like we're buying the car twice this year because we have a young driver. Life insurance for people that are in the military. Most insurance companies just won't offer that insurance. USA is one of a few exceptions that does, but they limit it very low. Fortunately, now the military pays really good life insurance to the military deceased and to their families. So that's kind of nice that they finally did what they should have been doing. It's hard for the insurance industry to do that. So the best thing to do is risk avoidance. After that, it's just retention. You just got to face the fact that you have that loss. If it happens, you're going to be wiped out. And that's all there is to it. the insurance is going to be so expensive, you're just going to find there's no reason to even look at it. So we get to what really makes sense, and that's things that don't happen very often. And when they do happen, they're catastrophic. They really bother you. The fact that they don't happen very often keeps the insurance costs really low. You don't have all these transactions that the insurance company has to handle. But the fact that it's high severity, you really like to be able to shift it to somebody else. And most of what we're going to look at in this class, parts A and D of auto insurance, parts A and B of homeowners insurance, most of it fits very clearly into that caption. We're going to talk a little bit about rate online here next. So I want you thinking in terms of that. I want you to actually go back to your policy and look at this, because it's not an all or nothing. Part D of auto, and you may know what Part D of auto insurance is. 2 C's in it, blank and blank. Nobody knows. I mean, you own this stuff, right? So comprehensive and collision is the physical damage part of your auto insurance. So low frequency, high severity. Well, if your deductible is $100 versus your deductible is $5,000, how does that affect frequency and severity? If your deductible is $5,000, you're going to have much less frequency and much higher severity. If your deductible is $100, you're going to have much higher frequency, you have more claims, but lower severity. So I want to go there next, all right? But the only place it really makes sense to buy insurance, in my opinion, is when you have low severity on stuff that is really painful when it happens. Low severity keeps the insurance costs down, all that expenses and loading, and the high severity means it's actually valuable to you. Now, it's still a lot losing proposition. On average, you're still going to spend more for the insurance. In fact, there's a good chance on this insurance, you might pay insurance your entire life and never have a claim. So 100% of what you pay is completely wasted. But it's low enough cost because it doesn't happen very often that it's not all that painful to you. And when it does happen, and you have this $70,000 expense, you're really glad you have that $70,000 coming in to help you out there. So let's talk about rate online. If you're an actuary, you really should know this term. I probably don't teach it the same way they do on the actuarial exam, so don't over rely on my definition. I do it in the way that my brain understands it. But let's look at it. I'm going to give you some live numbers here, all right? So I want y'all should go try this on your own. You know, as they say, try this at home. It's not dangerous. So this was my auto insurance policy. It was probably my Prius, my 13-year-old Prius. So I finally went the no Part D. I just went self-insured because it wasn't worth anything. But when it was a newer car, on Part D, so remember Part D is, just think of Part D as physical damage to a car. It's comprehensive in collision. So it means you have a wreck, it covers the collision part. The comprehensive is everything else. A tree falls on your car or whatever, right? So it essentially covers just about everything on your car. It's really good coverage. Even covers, we're going to talk about parts B and D, parts B and C. And a lot of people say, hey, I better have uninsured motorist coverage, because if an uninsured person hits my car, I don't want to pay to replace my car. But no, Part D covers your car even if an uninsured motorist hits your car. So Part D covers damage to your car that's not insured somewhere else. So it's pretty comprehensive. That's why they call it comprehensive. It covers you pretty well. So I had 3 choices I looked at. I could do $1,000 deductible. That premium was $290. I could do a $500 deductible. That premium was $336. Or I could do a $100 deductible. That premium was $476. So what I said is, what's the difference between a $1,000 deductible and a $500 deductible? Well, it's $500. How much am I having to pay to get $500 of insurance? Well, $336 minus $290 is what? $46. I'm paying $46 to get $500 of coverage. Or my rate online is 9%. I'm paying 9% of the coverage to get that coverage. Why do you want the rate on line to be? You want it to be very, very low. The lower the rate on line, the more bang for the buck you're going to get. Now, I'm not saying that it's like mispriced or something. You're getting paid for what you're getting, but you're better off, I think, with the 500. Why? Because let's look at the $100. You're getting 400 more coverage, $400 more coverage than you would with 500. So you're getting $400 in coverage, but you're paying $139 for that coverage. For every dollar of coverage you're getting, you're paying 35 cents in premiums. You better have a claim every 3 years, right? Y'all see that? Or you better have a claim every 3 years. How many of y'all having insurance, auto insurance claims every 3 years? If you are, your insurance company is not real friendly to you right now. So I've had 0 insurance claims in my life. So yeah, it's kind of a waste. So I actually had $1,000 deductible, and then when the car hit 10 years, I went to 0. I had no Part D at all, completely eliminated. I just say, hey, if you total my car, I'm going to pay for them to tow it away. I'll go to the car dealership, buy a new car, and go home. That was my opinion. I'm not gonna cry tears over a 10-year-old car that's worth $300 or whatever. So. But while I was new, if it's a $30,000 car, yeah, I want some coverage, but I actually get the $1,000 coverage. But if I were choosing between 100 and 500, this is how I would do it. Why didn't I do a $5,000 deductible? Well, they didn't offer me a $5,000 deductible. And they just think, that's kind of ridiculous. If you got a $30,000 car, why are you doing? But, I probably would have done a $5,000 deductible, but, or I would have looked at it, but I probably would, at that case, said, you know what, $1,000 is probably better than 5,000, because the difference between 1,000 and 5,000 probably would not have been that much. All right. Anybody have questions on rate online? It's a really important concept. Insurance companies use this when they buy reinsurance. So USAA might go out and buy insurance that says, hey, if we have a hurricane loss, if that loss is over $1 billion, this covers us for the next $500 million. And they want to know how much is that premium to get that $500 million coverage. That's that rate online. And so it gives you a really good sense of, so you can compare one versus the other, but also can y'all see how y'all can use this to make decisions about how you buy insurance. This is expensive. Low deductible Part D is very, very expensive. You're essentially paying for it every 3 years. And boy, if you have an accident every 10 years, you're grossly overpaying for that coverage. All right, I'm not seeing any questions on that. I don't see anything on chat. Hopefully y'all understand that. So how did I do this? I went to USAA.com. I went to the pricing. I don't know if your insurance company does this, but they probably do. I just had them reprice my auto policy at $1,000 deductible, at a $500 deductible, $100 deductible. I wrote down the premiums, compared them, and I made that decision. Sure enough, you do the $500 deductible and you crash your car tomorrow. So you're on your own. I'm not making any decisions for you. There's the Murphy's Law on this. But even then, it's only $400. It's not the end of the world. So you have to decide. To me, $400 is not material. It's not severe. For a college student, maybe it is. I don't know. You have to decide what's real severe. If you're like $400, boy, that wipes me out. If I have that, then maybe you should pay for the $100 deductible. You're still going to be out $100 in that case, but you won't be out the $500. All right. So that's what rate online means. Great concept. I love the concept. And it's a good way to help you understand this frequency versus severity. If you're buying insurance for a high frequency event, high frequency events have very, very high rate on lines, which means you're really paying a lot for not much. All right, so we answered our first question. When should individuals buy insurance? They should buy insurance for low frequency, high severity events. That keeps all those loaded costs of the insurance as low as possible. So you're not paying that much more than your expected loss. You're keeping that insurance part of the equation as low as possible. All right. So we got one question down. Any questions on question one? So some of you are kind of like stressing out, like, man, what insurance do I have? Are you wasting money on insurance? You might think about that. I even wonder if some of you even know what insurance you're paying for. Do you have renter's insurance? Do you have Part B and C auto? Do you have any homeowners? If you have renters, what are you buying on the renters? What's your limits? There's a lot of college students, they're doing exactly whatever their mom or dad told them to do, right? It's just habit. That's what I did in college. It's like, Dad, what do I do? Oh, you just buy this policy. Okay. I didn't think about it, ask questions. I didn't ask what was the best answer. It's just like, I do what everybody else does. So I didn't spend any time on it. My dad didn't spend any time on it. He did whatever his agent told him to do. Why did he do that? Because his agent sent him a birthday card every year. So yeah, this good guy sends me a birthday card. He must know what he's talking about. Not much thought going into this, and yet it's a pretty good part of our budgets. We're spending a lot of money on this, so we should ask that question. All right, let's get to this crazy second question. This one I absolutely do ask on the exam. Not when do corporations buy insurance, but why should corporations buy insurance? I should really change this, should or should not, right? Why should implies that they should, and in fact, the answer might be that they should not. In fact, you're going to notice that that may actually be the answer if you use financial theory. All right, so let's get into this. To answer this question, we need the most famous theory in finance, the capital asset pricing model. If you don't know this model, then you're gonna have to refresh yourself in this. So the exam question, you have to start off explaining CAPM, but that's not what the question is. This is not as what is CAPM question. The hardest part of this question is what does it have to do with the question of why should or should not corporations buy insurance? So let's refresh. Hopefully y'all are all CAPM experts. If you're graduating with finance, you should be. If you're an actuarial major, Lindy, I'm pretty sure you can see CAPM pretty early, and you probably have had it in some classes. You all had 3013, and you had a lot of CAPM in 3013. I took the CFA exam, and part one of the CFA exam had a bunch of CAPM questions, fortunately, because that's the easiest question of all. Just plug 3 numbers into a formula. So what is CAPM? First of all, it was written by William Sharp. He's got a website with all of his articles. So you can go out there and do that. I've never read his actual PhD paper on CAPM. I should do that. It'd be interesting. He wrote it back in the early 60s. He wrote it about the same time I was born. So it'd be interesting to see how mathematical it is and if the math would be too tough or not. What does CAPM stand for? It's a capital asset pricing model. It's a really horrible title. Capital asset implies that it applies to all assets, stocks, bonds, real estate, but it doesn't. We really only use it for stocks. So capital asset, it really should be stocks. You could say equity. Some people say equity model, but even equity, that includes real estate. I don't know anybody who uses CAPM for real estate. So it really is a model we use just for stocks. The P stands for pricing, but the capital asset pricing model does not provide you a price. It provides you a discount rate, a cost of capital to price a stock. So that's not even correct. And it's not a model, it's a formula. So it's really a horribly titled thing. I don't know why he came up with cap. I think he actually did intend this to be all capital assets when he wrote it. But you would never use CAPM for a bond. You would never use CAPM for real estate. I wouldn't think. I mean, it's possible for real estate if you have a large enough portfolio, but it'd be pretty rare. I don't know anybody in real estate that actually does use that. So we're talking about a pricing model, which means CAPM is all about risk. That's what we're all after. How do you measure risk? So the cost of equity capital, we say equity. I don't like the word equity. Equity can mean stocks, but equity can also mean stocks and real estate, anything you own. So cost of equity, we usually mean the cost of stocks, the stockholders, their cost of capital. For an individual company, we write it as KE, cost of equity capital. It's the risk-free rate. So what can you get from like a 10-year treasury risk-free plus beta times the market risk premium. The only part of this equation we care about for our question is the beta. Okay. For this question, beta is the only thing that matters. So on your exam question, you don't need to go through what risk-free rate is, what the market risk premium is. The formula for capital asset pricing model is risk-free rate plus beta times the market risk premium. That's how William Sharpe says we should adjust an individual company's discount rate for its risk. And beta is what? Beta is the measure of risk that's specific to the company. Y'all remember that from 3013 and 3030 whatever? I can't remember what all classes y'all had. I don't know who in here had my investments class, but I'm sure y'all saw it. If y'all took principles of investments, you would have had it in there. Jacob, you were in my investments class, weren't you? A couple of y'all, I think, were. So beta is the key to this question, all right? So what is beta really telling us? Well, what William Sharpe says is stocks have two types of risks. Now, this is really key. Make sure y'all got this in your notes, all right? Stocks have two risks. Anybody know what they are? I remember them. Mitchell, you're in my class last semester. What are the two risks according to CAPM? Jacob, you remember?
Systematic and unsystematic.
Exactly. Systematic and unsystematic. What does beta measure? The relative systematic risk of a stock. Okay, so in your answer on the exam, you need to say that stocks, the discount rate for stocks reflects the fact that stocks have both systematic and unsystematic risk. Total risk of a company's stock equals systematic risk plus unsystematic risk. But beta only measures a company's relative systematic risk. What does it do with unsystematic risk? Completely ignores it. All right, that's real key to this question. We're getting to the central argument of this problem. Beta measures only the systematic risk of the company, ignores unsystematic risk. So beta is a measure of the relative. It doesn't measure systematic risk, it measures the relative systematic risk. So the beta of the market is 1. So if a stock has a beta of 1.4, we say they have 40% more systematic risk than the average stock out there. So it's a relative measure. If a stock has a beta of 0.6, like a Kroger's grocery store, we can say it has 40% less systematic risk. How much unsystematic risk it has? We don't know. Beta doesn't measure that at all. It completely ignores it. So that's really key. William Sharpe is actually telling you you can ignore the unsystematic risk of a stock as long as that stock is in a well-diversified portfolio. Right? So the question is, you want to put this on your exam, give some examples of what a systematic risk is, you give some examples of what an unsystematic risk is. So a systematic risk would be things like the economy. Are we going into recession? Interest rates, inflation, the stock market itself. The stock market itself crashes, it tends to pull all stocks down with it. Commodity prices. Those things that tend to affect all companies, they may not affect them all equally. So some things like a recession are going to impact GM a whole lot more than it's going to impact Dollar General, but it does affect all companies. All companies have some exposure to systematic risk. If they have a high beta, they have a lot of exposure to systematic risk. If they have a low beta, they have a muted exposure to systematic risk, but every company has some exposure. All right, so beta is, it really is an opinion of what you think the company's sensitivity is to these systematic factors. All right, so that's systematic risk. You cannot eliminate systematic risk by simply throwing more stocks into your portfolio. You would have to specifically find stocks with low betas and put them into your portfolio. That's the only way to reduce the beta of your portfolio. So if you want less systematic risk, you have to sell stocks with high betas and buy stocks with low betas. That makes sense? That's how you reduce systematic risk. Questions up to there? I mean, this should be refresher stuff you've had before. And Wikipedia, Investopedia will cover this as well. If you're kind of like, what is he talking about? You should have had this probably in at least 2 or 3 classes by now. Again, I'm not sure about you actuary majors. I'm not sure exactly what you've seen. Betas are terribly unstable. That's why I don't use historical betas. To me, betas, you look at the company and say, yeah, its historical beta is 1.2, but this stock should have a beta of 1.6. I mean, this is a very risky stock. By risky, I mean very sensitive to the economy. All right. So as I said, the only way to reduce systematic risk is to take less of it. Buy low beta stocks. But unsystematic risk has to be in your definition because that's where we're going here. That's where we're driving to. All right. This is what's going to bring capital asset pricing model into this discussion. Don't forget what we're talking about. Should corporations buy insurance? And it's this unsystematic part that's going to really tie all this together. Unsystematic risk is industry or firm specific risk. It's diversifiable, which means you can easily eliminate it by simply throwing a bunch of stocks into your portfolio. Somewhere around 20, 25 stocks, and you fully eliminated unsystematic risk. Because one company has bad news, that's offset by another company has good news. You don't care about the unsystematic risk. What William Sharp is saying in the capital asset pricing model is investors should not expect any compensation for taking on unsystematic risk. They shouldn't have to worry about it. They're already taken care of because it's eliminated. It's disappeared. It's not in their portfolio at all. They don't have any unsystematic risk because they have 40 stocks in their portfolio. So it's not there. That unsystematic risk has disappeared. And unsystematic risk is a huge part of the risk of stocks. It represents, in a typical time period, about 75 to 85% of the risk of the stock. So when we say beta measures systematic risk, beta is only really addressing 15 to 25% of the risk of a company. The rest of that risk, William Sharp is saying, just ignore it. It disappears when you diversify your portfolio. That's a pretty radical thing to say, wouldn't you think? You're going to ignore 85% the risk of a company, but yeah, you ignore it. Why? Because another company's going to have good news and offset it, and you're perfectly fine with it. All right. I don't know if y'all have, I can't tell, especially, live, it's a little easier, especially since most of y'all are not on videos, so I can't tell if y'all are getting it. The ones that are on video, I know y'all got it, but none of y'all look too. But if you have a question on this, ask it, because you might have had beta and CAPM in our previous class, but you might have forgotten about it. And this is a good time to catch this back up, because CAPM is one of those things you absolutely need to make sure you know when you graduate. It's one of those foundational basic things all finance majors know. But I asked that in a lot of interviews, and I can tell you the majority of finance undergraduate majors have a very shaky understanding of capital asset pricing models. You really want to solidify. It's a good chance in this class to get hit with it one more time so you can start just really understanding it. But I'm not seeing any questions. So let's see if we can tie this. See if we can tie this to the question. So beta is a measure of relative systematic risk. The formula is covariance divided by the standard deviation of the market squared, or it's the slope of the stock relative to the market. It's an unbounded statistic. It can be 2, it can be a billion, it can be negative 74, it can be any kind of number. Correlation is not unbounded. Correlations between -1 and +1, but beta and correlation are almost the same formula. It's really, you should know these formulas off the top of your head, but it's not that difficult because they're almost the exact same formula. It's covariance divided by standard deviation. It's just what standard deviations do you use? For beta, we only use the market standard deviation. For correlation, we use the market standard deviation and the stock standard deviation. The formulas are very, very, very similar. You don't really need that for this class, but just reminding you of these formulas. All right, so what in the world does this have to do with should corporations buy insurance? So here's where students really miss it on the exam, because exam's a few weeks away. I'm telling you something really important. And some students, because it's 9:40, they're really tired. They've had a long day. They're not going to take notes, but wake up. If you're asleep, wake up. This is really, really important. What is the key? The key here is, are insurable risk systematic risk or unsystematic risk? is what companies buy insurance for. Are they buying insurance for systematic risk? Are they buying insurance for unsystematic risk? And most insurance that companies buy is to cover unsystematic risk. Property insurance, general liability insurance, boiler machine insurance, inland marine insurance. These are all covering unsystematic risk. What did William Sharp say about unsystematic risk? What's that word I use? You want to put that in your answer? I think I said it, but it's not in there. Y'all remember the word ignore? William Sharp says, what about unsystematic risk? You can ignore them in a well-diversified portfolio. Why? Because they completely disappear. Well, if insurance is covering unsystematic risk and unsystematic risks disappear in a well-diversified portfolio, why is the company buying insurance? So William Sharp's saying they're buying insurance for something that's already been eliminated. Isn't that what he's saying? That risk is already gone.
But I mean, that's like from an investor's perspective. But from the company's perspective, that's 85% of what they have to worry about.
Right. You're getting to why we're going to get to that. So Mitchell, they do buy insurance and why. So good. I'm glad you said it, Mitchell. So right now, I really am focusing just on the stock market, stockholder. So we're going to get into management and vendors and bondholders and the others groups. You're exactly right, Mitchell. There's other stakeholders that unsystematic risk is a big deal to them. No question. So good point. But right now, just think about the stockholder. From a stockholder standpoint, do stockholders want management buying insurance? And according to CAPM, William Sharp says no, they don't have that risk. It's already been eliminated. Now, are there some insurable risks that are highly correlated, that are systematic? And there are some. D&O is probably a systematic risk, directors and officers insurance. So what is directors and officers insurance? Boy, I knew a lot about it when I was at USAA. When I was at USAA, if I made a bad decision, like I had USA's 401k plan and our pension plan, if I made a bad investment decision, those were like $7-8 billion in assets. Every employee at USAA could sue me personally for that bad decision. That's kind of scary, isn't it? I'm managing $8 billion in assets, and if I make a bad decision, I can be sued for millions and millions of dollars. So what did USAA do? They bought D&O insurance to cover me for that risk. So that if I got sued, USAA would step in with that insurance. Well, when do people sue directors and officers of a company? They do it when the stock price falls a bunch. You don't sue management and directors when their stock is up 40%. You sue them when the stock is down 40%. Well, if you have a stock market crash and stock markets are down 40%, a lot more people sue directors and officers. So there's a correlation between D&O insurance and markets. There tend to be a lot more claims for D&O during market crises than there are other times. So that's true. Terrorism risk, 9/11, when it happened, definitely stock markets fell dramatically around the world because of that. So there are some insurable events that are systematic risk, but they're the majority. They're the minority. Most insured risks by corporations are unsystematic risk, and CAPM says you don't need to insure those. They've already been eliminated through diversification, right? Now, ignoring Mitchell's point is an extremely important point, but at this point, we're going to ignore it. Purely from a stockholder standpoint, CAPM definitely says you don't need to insure. Most of the insurance you're buying is a waste because you've already taken care of that risk through diversification. Now, some of you are going to say, well, then that means companies just buy insurance for D&O insurance, D&O risk. I'm going to argue even then it doesn't make sense. All right. So why is that? See if I can convince you of that. Okay, let's try this. I don't want to blow your minds because it's 9:45, but it wouldn't be all right. That'd be all right. Be shocked at 9:45. So let's say we have two companies. All right, let's say you're a stockholder. You have this huge portfolio one of the companies is a retailer. I don't know who it is. Maybe it's Best Buy. I don't care who it is. I used to use Toys R Us, and they went out of business. I was still using Toys R Us, and so I was like, oh, forget it. So let's say Best Buy. So let's say Best Buy has $1 billion in revenues. And Chubb, y'all know who Chubb is? Big commercial insurance company. Let's say Chubb has $500 million in revenues. And both of these companies are in your stock portfolio. And Best Buy has $800 million in expenses. Chubb has $400 million in expenses. Their net income is 200. Chubb's is 100. But let's say they have a $500 million property loss. Let's say Best Buy has this massive thing hit, maybe a massive warehouse, $500 million is a pretty big warehouse, and they have a loss. So let's say, I'm ignoring taxes. Let's say after that loss, they lose $300 million, right? Before the warehouse burned down, it would have made 200, but because the warehouse burned down, they've now lost $300 million. How did your stock portfolio do? That's kind of bad, right? Chubb doesn't have Best Buy as a client, so they don't care. They made $100 million either way. So your portfolio before this loss, your portfolio would have had $300 million in income. But because Best Buy had that big loss, your portfolio had a $200 million loss. You're kind of upset, right? You can say, my word, wish we had bought that insurance, right? Because Best Buy, boy, they had this property loss. If they bought insurance, I wouldn't have lost $500 million in earnings from Best Buy. So you say, Best Buy, yeah, you guys need to go out and buy insurance. So Best Buy says, okay, we'll buy insurance. So we have $100 million in revenues, $800 million in expenses, but we spend $50 million on insurance. And so the $500 million loss happens. And what's our income? It would have been negative 300, but now it's negative. Now it's positive 150. Why? We paid $15 million for insurance. The $500 million loss happened. Chubb paid $500 million loss. Boy, we're happy, aren't we, as a stockholder? And then we come over to Chubb. Chubb now has, y'all see why Chubb has 550 in revenues? Where did that 550 come from?
From Best Buy.
Yeah, plus the 50, right? And they have underwriting expenses of 420. What happens to their expenses? Why did their expenses go up 20 million? Well, you can't add a new major customer like Best Buy and it doesn't cost you money. You're gonna have adjusters, you're gonna have policy service people, you're gonna have people going out there. So it's gonna cost Chubb $20 million to put a big line of business like this on the business. Maybe not that much, I may be exaggerating, but I just want to make the point. So it looks like Chubb's income went up $30 million, but what did I leave out?
Insurance.
They had to pay $500 million. I can't get my minus sign to work for some reason. Wow, my keyboard is really, I don't understand why it's doing that. Oh, I did minus. Let me do plus. That makes more sense. All right. So they had a loss and their net income, instead of being $100 million, actually fell to 370. So let's look at the difference. Their revenues for your portfolio, your revenues went up 50 million. That's kind of nice, isn't it? What did your expenses do? Your expenses went up 20 million. All right. The insurance claim, the insurance net insurance, your portfolio lost 450. Your net income is negative 220. What was your net income before Best Buy bought the insurance? How did your stock portfolio do income wise? It was negative 200. Now Best Buy's bought the insurance. What's your portfolio's net income now? Negative 220. Why did you lose an extra $20 million? Anybody see where that comes from?
Because there was still a $500 million loss in your overall portfolio, but now you have to have the payments and the expenses for insurance.
Exactly. Yeah, Lindy. In fact, we're talking about you, Lindy, right? We're talking about actuaries and investment people, right? We had to pay Lindy's salary. She charges $20 million a year to do Best Buy as a customer. We had to pay her salary. You as a stockholder, what is that $20 million to you? Are you glad you paid Lindy $20 million? She's glad, right? But what did she do to your portfolio? She just cost you 20 million bucks. Are you any better off? You're worse off. I call that expense leakage. You got to pay the insurance company for their employees and all of that. You know, that's leaking out of your portfolio. You're losing money doing that. Your portfolio would have been better off if Best Buy had not bought this insurance. So even if this is for D&O insurance and it's systematic risk, you're not going to come out ahead because you have both your insured and the insurer in your portfolio and you're incurring expenses. It's left pocket, right pocket. You cannot come out ahead. Questions on that? I know you don't need to actually put this on exam, but you definitely could. I do have some students who actually come up with their own math example to answer the question. So you should do that. I'm sorry?
Wouldn't wouldn't it be like part of diversifying your portfolio to not invest into an insurance company who has another part of your portfolio as a client?
That's true. You could do that. That's kind of a strange thing to leave insurance companies out just because of this one thing. You could certainly do that. You're still going to have some expense leakage because what I didn't show in there is that Best Buy has some costs. Remember, they're going to have a department that handles all the insurance contracts, and so they're going to have some costs. It's probably going to be immaterial to you as an investor. I think it'd be strange for investors to say, I'm going to buy everything but commercial property and casualty insurance companies. But it's possible. You could argue from that standpoint. I've tried to think of other scenarios because obviously Best Buy buys stuff from Amazon, don't they? They're probably an AWS customer. Definitely Netflix buys stuff from Amazon. But if you actually sit down and do the math, it's not the same. It's really hard to come up with something like these insurance losses. They're very unique. There's a one-time kind of out of left field kind of large losses. What Netflix is doing with AWS at Amazon, that's an ongoing business. It's very predictable. We need Netflix to do that because Amazon's better at it than Netflix. So both companies come out ahead. Yeah, there is some expenses, but their expenses would have occurred anyway because someone's got to do all of that. Your portfolio really does come out better because Netflix buys all those services from AWS. I can't get if y'all can think of a same scenario somewhere else that is left pocket between two companies in your portfolio, let me know. Most things that you can think of are very different than insurance. Insurance is a very unique type of business. And so, yeah, I don't know, Mitchell, I would have to sit down and try to think through that. What would happen if I just don't buy insurance companies?
But I was saying, if you have a majority of companies in your portfolio who have insurance with a certain company, just not by that insurance company, by a different insurance company.
Yeah, that's going to be real tough because you're buying 50 companies. You're going to have a tough time even finding out who their insurance company is because they're not going to tell you that. That's inside information. It makes sense theoretically, and we will talk a few places theory, which you can't really implement because you can't get the data. So theoretically, that could make sense, and it would make sense from the capital asset pricing model. You eliminate that left pocket, right pocket, because you might have an event that does affect everyone, like a major hurricane or something, and it would be nice if someone outside of your stock portfolio was funding all of that. So I'm not saying there's not some scenarios, but the general scenario is you're going to have a tough time coming up with a corporation buying just regular insurance from companies that are also publicly traded, and your portfolio comes out ahead. You're just going to be having expenses because these are left pocket, right pocket type of expenses. So essentially what capital asset pricing is saying is when management buys insurance, they're essentially spending stockholder money to eliminate a risk that the stockholders have already eliminated. That's essentially what this argument is doing. The stockholder is saying, hey, management, we can eliminate that risk ourselves through diversification. Why are you spending corporate resources to eliminate that risk? And Mitchell, one thing to your point is when, remember, when Best Buy buys the insurance, that $50 million, that $50 million is going to cost more than what they expect to pay in those building buyers. So over time, you're going to actually end up spending more in the $50 million than you will getting back in the insurance. So you already know it's a losing proposition. So even from my standpoint, just knowing about insurance, your portfolio overall is going to spend more in the insurance than you're going to get back on average in claims. So I think you could make that argument. I'm glad you asked that question. I just thought of that now. It'd be a good thing to add to this discussion. We know insurance is a losing proposition. So even if you eliminate the insurance company, you're still going to come out behind in this analysis, because the stockholder is saying, we don't care. We don't need you to insure this risk. We don't even have this risk. It doesn't exist for us. Why are you buying insurance to eliminate a risk we've already eliminated? I call it expense leakage. On the exam, students call it expense leakage, and that's 100% of the discussion. And they get no credit for that. So you can't just say, oh, and by the way, there's also expense leakage, and then move on. You got to tell me what you mean by that. So the key there is you got a company and you got an insurance company. They're both in your stock portfolio. I mean, it's just left pocket, right pocket, and then they're going to pay employees to manage the business. You're just spending money on employees to manage an insurance transaction that you've already eliminated through diversification. I think it'd be great, since I just thought of it, also talk about the fact that insurance on average is a losing proposition. Be good to bring that in here as well. Let me see if I'm going to throw it. I'm not saying I'm going to put it on my rubric. So remember, insurance is a negative NPV. What does that mean? On average, you're going to spend more for the insurance than you're going to get in claims. So on average, you're going to lose money. So about the only way you can make it work is if you don't have many companies in your portfolio and one of them has a really massive loss and then you come out ahead. But that's going to be a tough thing to come up with that scenario. Another way I put it is you don't want management spending precious corporate resources and mitigating risk you, the investor, have mitigated. Why do I have these two words highlighted? So again, if you got distracted, come back to coherence. You got to get this in your notes because I do count off on this on the exam answer. Some students are real sloppy in their exam answer. Are they talking about management? Or are they talking about the stockholders? So they might say they don't want you to buy insurance. You mean who? Management? So be real clear. Are you talking about management? Or are you talking about the stockholder? Right here on CAPM, we're really focused on the stockholder. The stockholder does not want management. The stockholder does not want management buying insurance for a risk that the stockholder has already eliminated. Okay, you'll see how clear you got to be on this. Some students are real sloppy with that, and the way they word it is like, well, if you substitute management and investors, you switch them, the answer doesn't make sense. Does management, and this is to Mitchell's point, does management have a well-diversified portfolio? Does the CEO of Best Buy have a well-diversified portfolio given his or her risk to Best Buy? No, they're extremely exposed to Best Buy. Does the CEO of Best Buy worry about the unsystematic risk of Best Buy? You better believe it. They might have 90% of their portfolio in Best Buy. They're not well-diversified. So, and we're going to get to that point. There are other stakeholders. Management is not aligned with the stockholder in this equation. Management worries a lot about unsystematic risk because they have so much invested in the company. All right. So you can see why it's important to make sure you know which you're talking about, management or the investor. We're really focused on the investor in this first part. So how do you answer this question? Should corporations buy insurance? According to the capital asset pricing model, investors would say no. However, corporations do buy insurance. Why? because there's more people in this decision than just the stockholder. All right, y'all get that? That's kind of the bottom line answer. Should corporations buy insurance based purely on CAPM? And from this perspective, just of the investor, the answer is no. They've already eliminated the risk. They don't want you spending money to eliminate the risk. However, there are more people in this equation than just the stockholder. And so corporations do buy insurance because of those other stakeholders. Y'all get that written down, or is that too fast? I mean, you can go back and watch the video as well. When y'all buy that, one of the reasons I like doing this is you've been fed CAPM 2, 3, 4 classes, and you're told that this is the way everybody thinks, and this is it. This is the way finance works. Do you really believe it? I just gave you an example of CAPM being applied. Corporations shouldn't buy insurance from a stockholder standpoint. Does that make logical sense to you? If not, what's wrong with CAPM? From a stockholder standpoint, would you as a stockholder say, you know what? If it weren't for these other stakeholders, I would say management, don't bother buying insurance. I'd be better off as a stockholder. You're just wasting my money. Would you really and truly believe that? So, think about that. Maybe I'll keep you awake all night tonight thinking about it. I had professors do that to me at UT Austin. It's like, my word, I've never heard that question before. But I mean, that's part of the problem undergraduate. We show you this stuff as if it's just foregone conclusion. Everybody believes it. No, there's a lot of people who don't believe this stuff. They think it's not the right way to think about risk. So I'm giving you that conventional approach, and it gives you a fairly strange answer. All right, no questions on that? Some good comments. You're definitely understanding, the comments you're making, so you're definitely understanding the logic behind this. All right, so companies shouldn't buy insurance if all they cared about was stockholders, but what are these other reasons that actually mean not only do companies buy insurance, but they actually buy more insurance than individuals do? Commercial insurance is more than 50% of the market. So they definitely buy a lot of insurance. So the first thing is there are other stakeholders. The way that I do this on the exam is you got to go through that entire thing we just talked about before with CAPM and unsystematic, systematic risk. But then on this part, you're going to say, but companies do buy insurance, and I need you to give me 3 or 4 of these examples here. I don't need the entire list here. The most important one is that there are other stakeholders besides just stockholders. First of all, there's lenders. Do bondholders worry about unsystematic risk? So remember with CAPM, you don't care about unsystematic risk because if one company has bad news, another company has good news. So one stock falls 20%, but another stock's up 20%. It's a wash, you're fine. But a bondholder, if a company has bad news and they lose 20% on the bond, good news at another company, what happens to the bondholder? Nothing, right? They just keep collecting their coupon. There's no upside for the bondholder. There's only downside. So bondholders absolutely do care about unsystematic risk. Employees, they don't want their company going insolvent because they didn't insure a risk, and now the employee has to go look for another job. They want management to insure these risks like workers' comp and those kind of things. But probably even the bigger one is senior management, because there is an agency problem. It's hard to get senior management to always act on behalf of the stockholder. Management has their own problems. So management is heavily invested in the companies that they manage. And because of that, they are not well diversified. Remember, capital asset pricing model only makes sense if you're talking about a well-diversified portfolio. This doesn't apply to HEB. HEB is not a public company. The Butt family cannot well diversify their portfolio. Their wealth is in HEB. They're definitely worried about unsystematic risk. So always keep that really, really straight. CAPM only applies to well-diversified portfolios. So management, first of all, they're not as risk-seeking as stockholders. Why? Because they're not well-diversified. There's an agency problem that management will tend to be more risk-averse than the stockholders want them to be because management has a pretty concentrated investment in the company. So management is probably the biggest reason in there. Bondholders maybe as well. Bondholders, I think, pretty much just assume management's going to make the decision on their behalf. I don't know if there's bondholders that are going out there saying you better buy a lot of insurance. I think they just assume corporations do. Another group is vendors. When I did analysis at USAA, they'd ask the question, we're about to do this $300 million contract with IBM. Is IBM about to go out of business? Are they risky? I don't want to do this 5-year contract, $300 million with IBM if they're in financial distress. I might, in my contract, require IBM to buy insurance before I'll do the contract with them, because I just don't want to have that vendor risk. Regulators don't want any companies going insolvent. They don't have any upside. They only have the downsides. Regulators may require companies to buy certain types of insurance because they just don't want the risk to be passed on to other parties. All right. So there's the first group. It's the other stakeholders. And that's probably the most important part of the answer. And there's kind of some subgroups in there. A second reason corporations buy insurance, even though CAPM from a stockholder standpoint says not to, insurance companies know what they're doing. They're smart people. They have a lot of specialization. We're going to talk about a policy called boiler and machine insurance. This is insurance for very specialized machinery. The insurance companies that do that insurance, they know that risk better than anybody. They can actually come into the company and tell them, you're doing some stuff that's really going to cause you a lot of damage. And the company can fix some things with almost no cost and greatly reduce their risk. And that's part of what they're paying for the insurance. And that actually benefits the stockholder too as well. But there's value-added activities. Why? Because insurance companies specialize in certain things. They just understand it so extremely well. And so they're just better at it than the company. Maybe the company has a major furnace that they use, but it's not a big part of their business. But if it were to blow up, it could cost them a fortune. You have an insurance company comes in that they insure furnaces, and they can say, you know what, you need to have some maintenance on that furnace. That's going to blow up. It's going to injure hundreds of your employees. You can get a big headline risk. It's going to cause you all kinds of problems. It's going to be a lot of costs. And for just a few $1,000s, you can get maintenance on that machine and eliminate all that risk. Your stockholders are going to be glad you spent that $1,000 because it's really going to help you. Yeah, so that's another reason. A third reason is outsourcing. Insurance companies actually do things that if the insurance company didn't do it, the company would have to do it. But the insurance company can do it more efficiently because of economies of scale. Workers' comp is a good example of that. USAA outsources workers' comp. Why? Because they hired a company that had hundreds of employees, and USA didn't want it to hire 10, 20 people to do workers' comp. They'd rather hire this insurance company, let that insurance company handle their workers' comp claims. So that actually helps save them money. So it's an efficiency to us, and it's an economies of scale. Insurance companies just have a lot of employees that just do one thing, and so that economies of scale just makes them much more efficient. For small companies, the fourth reason is small companies, they may not be able to do anything without insurance. I remember I started a consulting firm. We didn't go much with it because I didn't have time to mess with it. But we had to buy insurance. Why? Because no one was going to give us a contract if we didn't have insurance. They're just not going to do business with us. But if I could buy the insurance, the simple fact that I bought the insurance gave my customers some confidence. Hey, someone looked at your business, someone assessed your risk. They're willing to sell your insurance. There may be something of substance here. That especially is true for new companies and small companies. It doesn't really apply to the USAAs and AIGs of the world, which are insurance companies themselves. And then the next reason is taxes. Insurance is very favorably taxed. And the reason for that is, this is kind of hard to explain, but I showed you the Best Buy. If Best Buy paid the insurance premium of $50 million, they get a tax deduction immediately for the $50 million. If they didn't buy the insurance, they don't get any tax deduction. And then 1 year they have this $500 million loss. That $500 million loss offsets all their income, so they don't have any tax. They may not get any tax benefit from that $500 million because they have too much of a loss. They can't carry the loss back. They don't have to wait for many years to carry it forward. But if they buy the insurance, essentially what they're doing is they're taking that $500 million loss, but they're getting the tax deduction year by year by year by paying the $50 million. Same thing with Chubb. Chubb's getting the $50 million in insurance, but they're getting to spread that out over time. They don't have to wait to get the tax deduction when they get the $500 million loss. they're essentially getting to spread that through the reserving process. They're getting to spread that over time. So what the insurance contract does for taxes, it allows you to take taxable losses earlier. You don't have to wait until you have, and if you have something that's going to happen once every 20 or 25 years, you'd rather be able to take that tax deduction over the 25 years instead of having to wait until the 23rd year when the big loss happens. All right. So it's hard to explain. It's a little complicated, but the way insurance companies do the reserving process, they actually get to spread those losses over time. It's easy to understand how Best Buy gets to spread it over time because they're paying the premium. That's pretty obvious. But the insurance company is essentially getting that same benefit. So that's nice. That's a good part of the tax part of it.
So I have a question. All these reasons why companies buy insurance, are they all talking about unsystematic insurance, like risk, buying insurance on an unsystematic risk?
Well, it could be both, but it's primarily focused on unsystematic. But some of these things are actually benefits to stockholders. I don't know if you added these all up, it might offset, what we talked about on the CAPM, probably not. It's probably a net loss to stockholders, but this does offset a lot of that loss. So some of this does favor and benefit, but most of this is workers' comp, property insurance. These are unsystematic risk, but this would apply to the systematic as well, the D&O and these other things, where the stockholder is saying, yeah, you are covering that risk, but I'm still paying more for the insurance than I'm going to get in claims, so I'm still worse off. Some of these are offsetting benefits that do help you with that.
Okay, thank you.
And the last one is regulatory. If you're a utility and your regulators are telling you what price you can charge, you want to buy the insurance because that insurance is an expense that you're just going to pass on to your utility customers. Why wait until you have a big loss? Pay the insurance. It's part of your rate base. You get it back from your customers. Yeah, makes no sense not to buy the insurance in that case. All right. Think through it. Generate your questions for next class because I hit you with a lot of stuff here. And this weekend, think about it. And also start working on the article because that's where we're going next. When can insurance companies sell insurance? And that's very much the Berkshire Hathaway side, okay? All right, that's all I have. I'll stay around if you have questions, but that's enough for 10:15.